Mr. Vimal, we discussed about various scenarios about the consolidation or the combination of financial statements or the standalone financial statement preparation is mandatory as per the corporate tax law. Now, we can discuss about, there are certain scenarios where we prepare consolidated financial statements, but, the corporate tax law specifically mandate you to have a separate standalone or even a splitting of consolidated financial statements. You need to split it or you need to break it.
Yeah, correct.
For the corporate tax purpose. For IFRS purpose, yes, we normally prepare it. Or for the management purpose or for the MIS purpose, we used to prepare consolidated set of financial statements. That is the in-house statements. But when the corporate tax is introduced, it's mandating, in certain scenario that we need to split it. So can you just brief it, what are the specific scenario where the accountants needs to split the financial statement from the consolidated set of financial statements?
Yeah, sure, Mr. JK. So we will discuss about 5 scenarios where splitting of financial statements are required for the corporate tax filing. The first scenario is where a combined books are maintained for the multiple licenses owned by the group. So this is a common scenario we have seen in UAE where the group have multiple companies and they are not maintaining separate books of account. They are maintaining a single books by combining all the financial statements. But as we discussed earlier also, if any of the conditions under Article 41 are not met, so then they will be required to file a return for the individual companies. So in this case, when the group is maintaining consolidated financial statements, they have to split this financial statement based on the individual companies and they have to file the standalone return to the authority. That is the first case. The second scenario is where a qualifying free zone is having a permanent establishment in the mainland. So here, although the corporate tax law says that a single return can be filed, but it also clearly states that there should be a proper segregation of the income and expenses for the taxable income from the qualifying free zone and the permanent establishment in mainland. So under corporate tax portal, there is a separate tab where you can fill the information for the qualifying free zone and for the permanent establishment in the mainland. So why it is required here is that if you look at for the qualifying free zone person, the tax rate is different. That is, it is taxable at 0 rate, and for the permanent establishment, it is taxed at 9%. So although a combined financial statements can be maintained, but for this segregation of income and expenses between the qualifying free zone and the permanent establishment is very important. Now, the third scenario is exactly the opposite of the point we just discussed earlier, where a mainland company is having a permanent establishment in the free zone, which satisfies the free zone qualified free zone condition. Here also a single return will be enough, but again you have to segregate the taxable income between the permanent establishment and the qualifying free zone person. The fourth scenario is where there is a mixed activity. For example, a taxable person or a sole establishment is having a mixed activities, like a sole establishment carrying on a business of bakery, which is taxable. At the same time, he also owns apartments, which he leases out for rentals. So in this case, that particular income is non-taxable. So if in this case, if he is maintaining a single books of account, it is required that at the time of filing the tax return, it has to be split between the taxable and non-taxable activities. So the last scenario or the fifth scenario is where there is a mixed use of assets. For example, let us take a case of a taxable person owning a property with 50 apartments, and he's using the 40 apartments for leasing out to holiday homes, which is a taxable activity. And the remaining 10 apartments, he is letting out for rentals, which does not require license and it is non-taxable. So in this case, again, if a combined financial statements are maintained by him, he has to split these activities based on the taxable and non-taxable activities.
Similar to the consolidation, when you split it also, there are some, it looks various scenarios that, the accountants should split the financial statements compared to the previous period. Previously, we used to have a habit that we see all the entities operating in the country, if it's a common owner, based on the requirement of the owner, we used to prepare consolidated financial statements. And then because the local law does not mandate that you should have a split financial statements, and we don't file it for any other purpose. Now the corporate tax law has come, and then the corporate tax law mandate the entities to split the financial statements if certain conditions have been fulfilled. So it's going to be a real challenge, no?
Correct.
Even the accountants, needs to go through some changes now. So by the introduction of corporate tax, as we discussed earlier, consolidation is a challenge, and there are a few challenges involved. Similarly, splitting of financial statements into smaller units will also have some challenges for the accountants. See, like Mr. Vimal was trying to say that, mostly the financial statements are splitting based on some, specific conditions. When there are multiple entities agreed, all have been preparing, and then which does not have much complexity. Instead of one consolidation, we do say 4 or 5 standalone financial statements separately for the corporate tax purpose. The confusion comes when there are common assets and, splitting of certain common expenditure. Or like Mr. Vimal was trying to say that some common assets have been used, and then there are some complexity in how to allocate the income and expenditure of such assets within the group. Those are the challenges which the accountants are going to face. And also derivation. See, opening balance derivation is also an important question, or rather it's a challenge, because talking about say for example taxed activity and non-taxed activity, say qualifying free zone and then the PE working in the mainland. When we have that, 2024, we are talking about 2024, year 2024. And what about the year 2023 financials? So it's a continuation. So basically, when we split the financials of 2024, there should be a corresponding, trial balance splitting or the financial statement splitting for 2023 as well. Otherwise, the opening balance generation would be a little challenging for the accountants. And then that is also a challenge. Both the entities, previous tax period is also, or previous accounting period also needs to be analyzed again for this purpose. And then, basically, the other challenge would be the information, necessary documentation and information available for splitting or allocating the common expenditure among taxable activity and non-taxable activity. That is also a challenge. So if we don't have a proper or sufficient documentation to prove that, the expenditures allocation, that's very important. Federal Tax Authority is going to be carefully scrutinizing such allocation and the basis of allocation, and the documentation behind such allocation is very, very important. And we should have an evidence of allocation of common expenditure among taxable activity and non-taxable activities. So that is also going to be a challenge. It is not just like a allocation based on a human judgment. There should be scientific evidence, but there should be a systematic method of identifying the allocation methodology, which will be requested by the FTA during their audit at later stage. And then also the selection of proper methods, method or the standard equation for allocation of common income and expenditure among the taxable activity or non-taxable activity, or when there are common assets used by different entity in a single group or in a single ownership, then that is also going to be a challenge for the accountants to allocate the expenditure or the income. See, the allocation of income and expenditure both are important. Say for example, when an entity operating in a country, be it in a free zone or outside the free zone, if they have taxable income, non-taxable income, that is the question. So when there is a 0% or when there is a 9%, or when there is an exempt income or when there is a taxable income. See, this is the scenario where the accountants are going to be really, it's a challenging scenario now since the corporate tax has been introduced. Though it's not a challenge, I don't see it as a challenge, but again, it's an additional responsibility on the accountants to split the financial statements into standalone or a small piece of efforts going forward because of the specific standalone financial statement purpose for the corporate tax law in the country.